Hello, my name is Zakaria Hashim Mohammed with ID number 0123201021. I will be presenting budgets and financial reporting, and I will be taking Banco Nacional de Bahis, especially its branch in Malaysia, as a case study. Before I start my presentation, would like I would like you to know that this budget is preliminary and it is only used for academic purposes. It does not apply to all levels. The authentic budget of BNP Malaysia. The topics that I'm going to cover during my presentation are going to be the following. I'm gonna explain briefly on budgets and business planning processes. I will also discuss sambal cash budget and sales budget of BNB Malaysia. I'm gonna also address what to include in BNB Malaysia annual plan. I'll also identify some common themes of budgeting in business. And finally, I will talk about components of a business budget. Uh, let's start from budgeting and business plan process. Um, Budgeting and business planning is a strategic planning process for determining and detailing an organization's long and short-term financial objectives and goals. The process is usually managed by an organization's finance department under the guidance of CFO, Chief Financial Officer. Uh, before before creating a successful business, um, you need to have these in your business. I mean, you are not going to have any other choice. You first thing first, you need to plan, okay? And uh, before you do anything, uh, planning is very crucial and important uh, for your business to be successful and sustainable one. In planning, you will know how many staff, let's say how many people your business will need, how much, let's say how much resources your business will need. Um, it's just you have to plan everything your business is going to have. After planning, you have to do budgeting. You have to prepare budget because you have staffs who are going to take wages and salaries from you. You're going to have resources. Let's say you're going to have computers. You're going to have some electronic devices that need electricity to properly work. So you have to prepare budget in order to cover all the needs that both your capital and your human capital need. And at the end of the year, you are going to have to make forecasting. Um, Forecasting is accumulating historical data on market conditions to predict financial outcomes for future months or years, aimed at helping management teams anticipate results. Result is based on past information. Forecast is also can be adjusted as new information is available. So your budget must go through this financial cycle, okay? You plan for and prepare next year's budget. And after making the plan, you have to monitor your spending through monthly financial reports. You can also do quarterly based financial reports. You can, yeah, it's not only monthly based. It can be 4 month based. It can based on 6 months. The choice is yours. And finally, at the end of the year, you have to make evaluations. And by doing evaluations, either your internal audit would do the job, or you can also hire some contractors, CBI, let's say, CBI certifiers, external audit. CBI is compliance and business integrity. So those who have certified CBIs can do the job for you, can do the external audit for you, for your business. Um, Here are some recommendations for a new CFO. You may start your job at any time in this cycle. We're talking about this cycle that we already talked about in the past slide. And you also need to find out what past practice has been by reviewing last year's audit reports for numbers and recommendations. You can also ask the treasurers and or bookkeepers to explain how they handle things. You also shouldn't rush to fix things right away if they are not broke at the time. Let's talk about cash budget. We will take a sample of BNB later. Cash budget includes expected cash receipts, cash payments, and resulting cash balance at the end of a period. Cash budget includes only the transactions where actual cash will come in or go out. This means creditors are not going to be included in your cash budget. Uh, in order to get cash balance, you need to subtract cash inflow from cash outflow. Cash inflow means all the sources from where company can earn cash over budget period, and vice versa. Cash outflow is all the payments, all the expenses you pay during a budget period. Here's an example, and our example will be based on quarter. We have here cash in hand 65,000. We also have sales, which is around 240,000. The forecasted total cash inflow will be 305,000. Here we have cash outflow forecast. It will also based on quarterly. Um, we have here payments for materials 80,000. We have labor payments. You can also use employee wages and salaries. We have 20,000 here. We have promotion expenses or advertisement expenses. You can say 10,000. We have printing expenses 5,000. We have maintenance 35,000, and purchases 120,000. So the forecasted total outflow is going to be 270,000. So in order to get cash balance, you follow the formula that we talked about in the past slides. You subtract the cash inflow from the cash outflow. We have 305,000 in our cash inflow. On the other hand, we have 207,000 in our cash outflow. By subtracting, you will have 35,000 US dollar as a cash balance, and this means that PMP has a surplus cash for its proposed activities from the financing budget. Sales budget is also, it will be also based on quarter. Okay, a sales budget is a financial plan that predicts a company's total revenue in a specific time period. It is based on two things: the number of products to be sold and the price at which they are about to be sold. We have sales 98,000. We have interest income. We are talking about banks. And whenever we talk about banks, we have to have interest income, okay? So that's why we include interest income here. Interest income, we have 42,000. Other operating income, 40,000. So the total forecasted sales budget will be 180,000. PMP annual plan. Uh, we will answer the question what to include in our in PMP business plan. Um, uh, Annual plan is activity-based plan that summarizes the goals, resources, and operations a company will execute in a year period. It usually includes an annual budget, project deadlines, roles, and responsibilities. Here are the steps that you need to follow for perfectly planning for your business. Um, Annually, we're talking about. Step one, you need to assess the current situation. Uh, in this step, you need to have bigger glasses, let's say that, in order to see things very clearly. Okay, by doing so, you will be able to understand whether the spending of your company increased, whether the spending of your company decreased, whether the spending of your company stayed the same. You will also be able to understand key areas that your company needs to improve. Step two, you need to set objectives, goals, and priorities by designing a well-justified pyramid business diagram in order to know which project should be implemented first, which activity should be started first, and of course, which department needs urgent stuff. Step three, you need to define your strategies and actions to all parties it may concern by different activities to be done during the year. Um, for example, you need to you would be needing to define the markets that your company needs to target during the year, and of course, the target sales your company should make really should make should really make. And in order to make sure your strategies and actions are well defined, you can use OKR as indicator. OKR is objectives and key results. You can use this indicator in order to understand that your strategies and actions are well defined and are properly executed. Finally, this is the most important step. You need to communicate the implementation strategies, and by doing so, um, you will share your action plans to all your departments and employees. Common themes of budgeting are the following. Master budget. Uh, this budget uses an aggregation of lower level budgets created by the different functional areas in an organization. Operating budget. The operating budget includes all the fixed costs, variable costs, capital costs, and non-operating expenses. It is very similar to a profit and loss report. Cash budget gives you an estimate of the money that comes in or goes out of a business for a specific period of time. Financial budget it- it makes you understand how much capital you will need and at what times for fulfilling short-term and long-term needs. Components of business budget are coming right here. Expected revenue. You can also say some people say expected sales. Okay, so they are the same. They give the same meaning. Expected revenue is an estimation of the money you are expecting from the sales and services your business does, and it focuses on two things. Um, Expected revenue based on two things: revenue forecast, and you can also say sales forecast. Okay, no problem if you say that, and cost forecast. Fixed cost. Fixed cost is um, everything that your business repeatedly pays um, for a particular activity or capital. When your business repeatedly pays the same amount for a specific time or for a specific activity or capital, uh, that time you are having a fixed cost. These fixed costs, they don't change, okay? For example, uh, this includes rents. This includes water payments, electricity payments, employee wages, internet services, and etc. etc. Variable costs are all the costs that change based on your business success or fluctuate based on the economic position that your country is in at a time. So these costs change over a period of time. One-time expenses, as you can see the statement, these expenses are based on one time. Okay, your company is going to, for example, let's say your company needs to buy a supercomputer. Let's say your HR department or marketing department needs to have a supercomputer in order to implement their actions effectively. So buying a supercomputer is one-time based expense. By that, you know the exact time, the exact month that you are going to buy that supercomputer. This is called one-time expense. And you have to include one-time expenses in your budget. Okay, you have to include cash flow. Your cash flow should be identified in your budget, and by doing so, will help you understand when your cash flow is high or when your cash flow is low. Is low. You can get the necessary information from your previous financial records to estimate your cash flow. Profit. You can calculate the expected profit by by subtracting your forecasted cost. from your forecasted revenue. If there is a surplus, that means your business is growing. If there is a deficit, that means your business is not doing well. That's the end. Thank you for your attention.